The lie that hurts disciplined people the most is this: if your money is invested, you are safe. You tell yourself the portfolio is the safety net. You look at the account, see a respectable balance, maybe even feel proud for not letting cash sit around, and you think you are being rational. Then real life sends an invoice with a deadline, and suddenly that beautiful net worth turns out to be cardboard. Picture the moment clearly: sitting in your car, phone in your hand, brokerage app open, heartbeat too loud. And this is the part people misunderstand. It is not a story about bad investing. The cruel part is this failure belongs to people who tried the hardest. It belongs to the oversavers, the diligent investors. And institutions love this confusion, of course they do. The more money you push into managed assets, the better the story sounds. That is the myth I want to break right now. Your financial problem is not always needing better investments. Very often your real problem is confusing net worth with usable strength. You thought being rich on a screen meant being protected in reality. Once you see that, your old effort starts to look shaky. It is not worthless, just incomplete. You were building the visible part of wealth, while completely neglecting the load-bearing part. And if that stings, good, it is supposed to, because once that illusion breaks, you can finally build something that works. In the world you actually live in, not the spreadsheet fantasy you were sold. Here is the part most people refuse to calculate honestly. Deep down, they know they need cash. Take the simplest example, an $80,000 reserve. Sitting in the wrong place, it looks safe because the number is there. But if it is parked in some sleepy bank savings account, opened years ago and never updated, it is doing almost nothing. Move that exact same $80,000 into a high-yield savings account, paying 4.5%, and the math changes immediately. Roughly $3,600 per year, with the money still reachable in 24 to 48 hours. It is the exact same dollars and the exact same owner. And this is where people get caught telling themselves a comforting lie. They say, well, it is only cash. No, a checking account earning zero is not neutral. Zero is not harmless. Zero is a decision. If your reserve generates no real return, you accept a silent drag, for no reason, and not because the market forced you to. Then you widen the frame. Immediate access cash belongs in the high-yield account. But the portion beyond that first emergency layer does not need same-day liquidity. That is where short-duration treasury bills start to matter. 1 to 3 month T-bills are backed by the federal government. They yield competitively with high-yield savings accounts, and they give the reserve a second spine. The only trade-off is timing. You are no longer talking about instant access by the hour. You are talking about maturity windows by the week or month. For money that is not your first line of defense, that trade is rational. Money market funds sit in that conversation too. Not as a magic replacement or an excuse to overcomplicate things. They just act as a useful supplement. They behave much more like a high-yield savings account in accessibility. They hold short-term government and corporate debt, and they have historically maintained a stable dollar value. Now let's get to the objection that sounds smart but usually hides bad math. If I redirect money into cash, am I hurting my long-term compounding? Yes, partially. That concern is very real. If you have trained yourself to respect compound interest, every dollar not going into an index fund feels like a future sacrifice. You can feel the phantom loss 20 years out, and that instinct isn't stupid, because the opposite choice has a cost too. If you stop investing completely while building a reserve, you don't just focus on cash, you give things up. You can miss employer match on a 401k. You can lose IRA contribution windows that do not roll over. And even worse, temporary pauses have a way of hardening into identity. People say they are taking a short break from investing, then 6 months later they are still paused. So the workable answer is not all in or all out. It is split allocation, parallel tracks. Keep the investing engine running while the reserve rises beside it. The ratio here matters because vague advice is useless. Run the numbers on a real household, and suddenly this stops sounding abstract. Let's say that after fixed expenses and bills, you have $2,000 a month left over, and right now all $2,000 goes into investment account. Under a 70-30 split, $1,400 still goes to your retirement accounts. You are still investing every month, you are still compounding, still participating in the long game. That $600 sounds small when you compare it to the final target. But monthly systems are not judged by drama, they're judged by whether they survive real life. At $600 a month redirected, assuming the H is paying 4.5%, you're adding roughly $7,200 per year to the reserve. That's not theory, that's arithmetic. If the larger reserve target is $60,000, for someone with $2,500 in monthly expenses, that becomes an 18-month project at that pace. 18 months. And notice what this math destroys. The emotional story says, if I build cash, I'm basically sacrificing my future. But the actual numbers say something much less dramatic. During those same 18 months, the portfolio is still receiving 70% of the original monthly contribution. The compounding machine never turns off. You're not gutting the long-term plan. That sequencing matters more than people think, because there's another mistake hidden inside the final target number. People stare at the big reserve goal and freeze. They hear $60,000 and mentally leave the conversation. Too far away, too slow, too hard. But that's the wrong picture. And that's the second proof, the one people feel in their body. The first proof is numerical, the dollars, the rates, the timeframes. The second proof is operational, how fast money can move. What can be accessed in 24 to 48 hours? What can wait on a 1 to 3 month maturity? What still earns while it waits? And what stops you from breaking your investment strategy? The moment life gets expensive, when a system works, it changes your reaction speed. It changes the pressure in your chest. The brutal part is this. The people who keep telling you that hard work solves money stress, they almost never mention ownership. They keep your eyes on effort because effort is what employees trade. Ownership is what protected people actually have, and a cash reserve sits right in the middle of that divide. This is why the reserve keeps getting misunderstood as money just sitting there. No, for most people that cash is not idle. It's the thin wall between you and forced liquidation. It's the difference between choosing and being cornered. The market doesn't have to crash to hurt you. Your life can do it for the market. A medical bill, a dead transmission, a slow client month, a broken water heater. And now the assets you thought were building your future, they get sold to clean up the present. Someone else gets to keep compounding. You get the receipt. And once you see that, the hierarchy becomes painfully clear. The person with no reserve is selling time. The person with a fragile reserve is selling options. The person with a durable reserve is buying time back. Same city, same prices, same inflation headlines, completely different financial species. Look at how the erosion actually happens. Not with one cinematic disaster, with reasonable little edits to the boundary. A flight upgrade because you've been stressed. Furniture because the balance looks healthy. A temporary loan from yourself because next month should be better. Nothing dramatic, no alarm bells. Just one hand reaching into the account, while the other hand says this doesn't really count. But that's exactly how people get harvested. Not by one giant mistake, by a series of acceptable exceptions that slowly convert a protective asset into a convenience fund. And the system loves that confusion. It wants every dollar to remain available for consumption. It wants your emergency buffer to feel morally optional and emotionally negotiable. Because a person who cannot go 12 months without a paycheck is easier to pressure than a person who can. Easier to keep in the job they hate. Easier to keep financing purchases. Easier to keep agreeing to bad timing, bad prices, bad terms. The reserve was supposed to give you walk-away power. The moment it becomes blurred with spending money, that power is gone long before the account reads zero. That's why the number matters less than the category. $80,000 can still be weak money if it has no rules around it. If your expenses are $4,200 a month, and you keep carving pieces out for things that felt important at the time, you're not looking at a pile of cash. You're watching runway collapse. 19 months turns into 15. 15 turns into something that looks fine on paper, but feels different in your body. You answer emails faster. You tolerate things you said you wouldn't tolerate. You stop evaluating opportunities on quality and start evaluating them on how fast they pay. That's the moment people think they're making independent choices, when they're actually making compressed choices under pressure. So the real divide is not savers versus spenders. It's people who have protected assets versus people whose assets are still exposed to daily light. One group keeps a firewall between survival money and lifestyle money. The other keeps everything in one emotional bucket and calls it flexibility. That bucket always leaks. This is why discipline is such a weak explanation. It flatters the story of personal virtue while hiding the mechanical reality. If your reserve sits one tap away, inside the same banking ecosystem as your everyday spending, then every mood swing, every bit of fatigue, every little justification has direct access to your protection. You're asking human impulse to defeat engineered convenience. That's not a character test. And bad design always falls hardest on the person with the least margin. Wealthier people can make sloppy decisions and still survive them because they own enough assets for errors to be recoverable. Most people do not, and for them, those small withdrawals aren't small at all. That's the ownership logic underneath the whole thing. If your reserve can be casually repurposed, you don't truly own it. Your impulses actually co-own it. So when we talk about protecting cash, we aren't talking about becoming stricter. We aren't doing it just for the sake of virtue. We're talking about deciding which layer of your financial life gets to remain untouched. Untouched by the ordinary appetites of the month. Because if every dollar is available, none of your dollars are actually assigned. That's the class line nobody says out loud. The people who seem calm aren't always more disciplined. Many of them simply built categories that lower friction people never built. They separated survival from spending and stopped asking their emotions to govern asset protection. They made some money unavailable to the version of themselves who is tired, the version that is tempted, optimistic, embarrassed, impatient, or trying to make things easier. And that's where the game starts to change. Not when the number gets impressive, but when the function gets protected. When cash stops being a vague pool and becomes a defended layer of ownership. A layer that daily life is not allowed to raid. Once you understand that distinction, the next question is no longer how much you have. It becomes, under what conditions is this money allowed to move? And that's where the real control begins. What would your money look like if it had rules strong enough to survive you? So make this brutally simple. There are only two doors through which reserve money is allowed to leave. Door 1 is a real emergency, where not paying creates permanent damage, or it creates a serious chain reaction. Medical bills, structural damage to the home, a real income gap with no cleaner bridge. In that case, use the money without guilt, because that's not failure, that's just the job description. Door 2 is a planned deployment into a clear opportunity. Not a vibe, not a hunch, not just thinking this stock seems cheap. A defined setup you decided on before emotions entered the room. This is where serious people separate themselves from people who are just financially busy. When markets drop hard, everyone suddenly starts talking about opportunity. But almost nobody can actually act on it. Why? Because their money is trapped in the very assets that are falling. They want to buy the discount, but to do it they have to sell. They have to sell something else at the worst possible moment. That's not strategic buying, that's forced rearranging inside a fire. Cash reserve changes that, especially if broad markets fall 30 to 40%. The person with liquid capital already in place can make a move. While everyone else is refreshing red screens and calling it patience. Picture it, you've kept $90,000 liquid for years, split between a high-yield savings account and short-term treasury bills. Then the correction hits, headlines get theatrical, and broad equities are down 35%. You don't touch the investments you already own. You just let them recover on their own timeline. But from the reserve, you deploy $75,000 into broad index funds and one real estate purchase from a seller who needs speed. A seller who needs speed more than they need top dollar. 5 years later, that discounted capital has grown to roughly $310,000. Meanwhile, the remaining $15,000 never vanished, it stayed liquid, and your regular income has already started rebuilding the reserve in the background. Now compare that to the person who stayed fully invested with no cash available. They may recover, their portfolio may crawl right back to where it would have been, but they were a passenger. The crash was something to endure, not something to use. Same downturn, same economy, same headlines. The deciding factor wasn't intelligence, it wasn't courage, and it wasn't perfect timing. It was whether the cash was sitting there before the window opened. And that's the mechanical point most people skip. You don't need to predict the bottom. You don't need a genius brain or nerves of steel. You need pre-written instructions for a future version of you. A version that will be operating under pressure. Because when markets are falling, your brain becomes a terrible investment committee. Everything feels different, and every commentator sounds urgent. Every red number feels like proof that this time is special. It usually isn't, but panic always claims to be unique. So do the boring thing now while life is quiet enough to think clearly. Take one sheet of paper, or open one plain note on your phone. Title it Reserve Rules, then write one sentence only. If broad markets fall by blank percent, I deploy blank percent of my reserve into blank. Fill in the blanks once. Maybe your threshold is 25%, or maybe it's 35%. Maybe you commit half, maybe 2/3. The exact numbers matter less than the fact that they exist before the crisis. No essays, no options, no depending on how I feel. One line, save it, that's the move. It sounds almost insultingly small. Good, small is what gets done. Small is what interrupts your old habit of making money decisions. Decisions made right in the middle of adrenaline. The point isn't to create a master plan that makes you feel sophisticated. The point is to remove improvisation from the one moment. The moment where improvisation usually costs you the most. When the drop comes, you aren't inventing a strategy with a knot in your stomach. You're just reading your own instruction and executing it. That one dry sentence does something powerful. It separates emergency spending from opportunity deployment. And it forces both to answer to a rule instead of a mood. Once that's in place, your reserve stops being a pile of extra money. It stops being extra and starts becoming infrastructure. And once money becomes infrastructure, the next question changes. It's no longer whether you had to use it. The next question is how you rebuild it without quietly wrecking your system. Before we go there, write your actual threshold down now, because if you can't name it in a calm market, you won't trust yourself in a falling one. Here's the part nobody promises you, because it's less exciting than maximize returns, and far more useful when life gets ugly. The goal of a cash reserve is not to make you rich. The goal is to stop one bad week from hijacking 10 good years. That's the real win if you use part of the reserve. You don't panic and turn the next 3 months into a punishment cycle. You don't shut off investing and obsess over restoring every dollar immediately. You go back to the same structure that built the reserve in the first place. The same parallel track. 70% of monthly surplus keeps moving into investments. 30% goes to rebuilding the reserve quietly, repeatedly, without drama. Because the moment you rebuild with desperation, you usually break something else. Retirement contributions, debt payoff, basic cash flow discipline, your own confidence. And the reason that matters is simple. Not every withdrawal means the same thing. If the money came out because your car died, your roof leaked, your dog needed surgery, or your hours got cut, that's not failure. That's the system absorbing impact exactly the way it was designed to. No credit card spiral, no brokerage liquidation on a red day, no sick feeling in your stomach while you tap sell, because the bill is due on Friday. The money did its job, and the cost was contained. But if the money left because a real opportunity showed up, a dislocation, a deal, a moment when cash let you act, then the picture changes. Now the reserve is being rebuilt, while the deployed capital is still out there compounding in a different lane. 2 engines running at once, one restoring flexibility, one growing wealth. That's what structure buys you, not perfection, not certainty, just the ability to keep moving forward, from more than one direction at the same time. Now be honest about who this does and doesn't apply to. If you're carrying high-interest debt, stop pretending yield solves that. Earning 4.5% while paying 20% is not strategy, it's leakage with better branding. The reserve can't outrun that drag. Clear the high-rate debt, then build the buffer. If you're early in your career, your income is stable, and your time horizon is genuinely long. Yes, your reserve can be leaner, and your investment allocation can do more of the heavy lifting. That can make sense. If you're within 10 years of retirement, the danger changes completely. At that point, the risk is not missing out on a little more compounding. You've had decades for compounding. The real threat is being forced to sell right when you need the money to live. That's where larger liquid reserves stop looking conservative and start looking rational. 3 to 4 years of expenses in liquid form at that stage is not fear. It's refusal to let bad market timing decide how much of your life gets sold. So no, this is not one size fits all, but the principle doesn't change. The right amount of money, in the right place, before the moment arrives. Because that's what was missing in the parking garage. Not a smarter fund, not a sharper ETF mix, not some secret allocation hidden from ordinary investors. Structure was missing. I had assets, I didn't have usable optionality. And when those two things get confused, you find out, very quickly, that a healthy net worth can still produce a desperate decision. That's why I don't want you leaving this with a fantasy. A cash reserve is not a magic moat. It won't erase job risk, market risk, health risk, family risk, or the fact that life can hit several categories at once. It won't make you fearless. It won't turn every emergency into a neat spreadsheet exercise. And it absolutely doesn't guarantee wealth. What it can do is smaller and more valuable. It can give you exit rights. It can give you time. It can give you enough space to say, I don't have to sell that today. I don't have to borrow for this. I don't have to take the first bad offer. I don't have to turn a temporary problem into a permanent scar. That's what survival capital is for, not lifestyle inflation. Not showing discipline on a dashboard screenshot. Not bragging that your cash is working. It's there so that when pressure arrives, your life doesn't instantly narrow to the worst available option. And once you feel that difference, once you know what it's like to open your banking app and see not just rent money and bill money, but actual breathing room, something else happens. You stop making every decision from a crouch. So ask yourself the uncomfortable question honestly. If your runway were 24 months instead of 3, what would change tomorrow? What would you stop tolerating? What would you stop selling? What would you stop fearing?